Consumer staples sector isn't the one you typically think of when you hear recession. The group is the third best performer this year, but not all staples are created equal. How do we pick through the defensive names, find the quality ones? Let's ask the lady with the top staples picks today, and one to avoid. Gina Sanchez is here. She's Chantico Global CEO and a CNBC contributor. All right, Gina, really honing in on those staples today. Your first one is General Mills. This one is a buy for you. It's up 3% this year, which is nice performance in a down market. It's up 5% this week alone. Why would you want to chase it?
Well, so this is a great company. It's hitting singles and doubles. You know, growth isn't expected to be huge, 3%, but it is expected to be positive. It's something that they're the kinds of products people continue to buy, but they have a really healthy balance sheet. They're at about 2.9 times debt to EBITDA compared to an average of 3.5. And right now, you don't want to be exposed to those rising interest rates. And quite frankly, they're at their valuation of 17 times, which is just below the sector. So it's really all around a good, solid holding.
Just for the heck of it, here's my big picture question about the staples today. Let's just say people start feeling a little more bullish because the Fed's kind of tamped out some of the worst inflationary pressures, and maybe we're starting to get our cyclical cojones back because we're not going into a recession. Could we see staples underperform, broadly speaking, in the next leg of this market?
So, you know, possibly, but if you look at the valuation, just from a valuation perspective, Kelly, it's just trading barely above the S&P. If you look at expectations for some of the growth of some of these names, actually, there's still some healthy growth built in there. And if you go into a cyclically bullish cycle, it's actually even better. And so from that perspective, you can play this both ways. You know, we're looking at some of the defensive names, but it's an interesting space.
Yeah, no, I take your point. All right, so let's move on then, talk Constellation Brands, which I think of more discretionary than staples, but this one is up 7% over the past year. Morgan Stanley reiterates it's a top beverage pick for this year. Tell me the attractiveness for you.
So now this one actually had a great run during the pandemic. The pandemic had a lot of day drinking. It had a lot of drinking in general. Funny, but recessions also cause that. And so we're still expecting some pretty strong growth, like almost 16-17% growth is expected next year. But if you look at the operating margins, which if you think about all of the things that could go wrong, it's that inflation is driven by all of this commodities inflation rather than the kind of inflation that interest rates hikes tend to address. Then you care about operating margins, and this has a really healthy margin. It's got a 26% margin.
Wow.
That's a pretty big space to be able to deal with really persistent inflation.
All right, so you like General Mills, Constellation Brands. Your third pick, which we actually heard from Kim Forrest, top of the hour, your third pick is Coca-Cola. Now, she liked it because of its kind of pivot into the alcohol business. We've talked about the Body Armor acquisition. I don't know if that's a factor for you. Why do you like the name here?
So, quite frankly, if you just look at the base product, the expectations for EPS growth in this for this name is 25% next year.
Jeez.
That is pretty healthy. That's a name that you can flex into, even if we go into a bullish cycle, right? And you get the kicker that they also have about a 26% operating margin. And so you get literally recession-proof and inflation-proof. This is a stock that actually looks really attractive. I mean, it's trading at a premium because of those factors, and you just sort of have to accept that because this is a hedge in both directions.
But isn't 25% earnings growth for Coca-Cola too high? I mean, does that look too aggressive to you? Is there a risk they'd have to take that down?
Even if they take it down and you end up with a higher EPS, you're still looking at a really high profit margin. And so that profit margin will still allow you to collect some of that. And so, again, you know, what we're evaluating against is what does the balance sheet look like? What does the demand look like going into a potential recession? And how much, you know, flexibility do they have in an inflationary environment?
Sure. And they've probably tried to demonstrate that they know how to navigate anything you can throw at them at this point. So those are the names that are attractive to you in the sector. Walgreens, on the other hand, is one you would bail on here. The worst performing consumer staple as well over the past year, and it's down 20%. What's going on here, and why isn't it a buy?
Well, so everything that I told you we're looking for are exactly the things that Walgreens doesn't have. I mean, this is a stock that has a really, really narrow margin, and it's really flowing through. You look at the expectations for growth next year. Analysts are expecting a loss next year. If you have this continued pressure, wage pressure, and or just input cost pressure, if they have trouble dealing with getting inventory, this stock gets hit, and that's the expectation. Now, you could argue at 8 times that maybe it's cheap enough that you could go in and hope for the best, but that's not really our strategy.